One of Kenya's top two banks, Kenya Commercial Bank, or KCB as it's more commonly known, has reported a 22% decline in net earnings for the 2020 fiscal year to $178 million. Now, the bank's stock of non-performing loans made up 14.7% of its entire loan book. That was marginally higher than the industry average at 14.1%. It's also a reflection of the wide economic damage that has been inflicted by the pandemic on the Kenyan economy, where 77% of the bank's assets are located. The bank's CEO, Joshua Oigara, argued that despite an uncertain outlook, there's progress being made in reducing the bank's stock of non-performing loans.
To be two-dimensional in this view. One is the period it's taking for us to be able to be confident about COVID. And number two, some sectors being reopened. So you have some sectors which are a bit held back today, maybe like in aviation, you haven't traveling as much. Hotels, we don't have as many tourists. Schools took longer to open. So we've done 106 billion by Q4. But by now, almost 30 billion of those have actually gone back to normal loans. So we have had almost a 35% recovery, if you ask me. And so I'm confident. And so now we're down to almost 70 billion, 72 billion to be exact. So you can see some progress. Yeah, so we see hotels, hospitality industry, if I classify that, some of our customers in manufacturing and aviation, that we see, and also some real estate. We see some delayed recovery. But on trade, on other segments like educations, financial institutions, on energy, we see, that's already picking up.
All right, then, Joshua Oigara, they're explaining the decline that is seen so far in the first quarter of 2021 in the amount of loans that the bank has restructured. So let's dig deeper into KCB's financials for 2020. Ronak Gadhia is the research director covering Sub-Saharan Africa banks at EFG Hermes. He joins us now live from London. Ronak, good to see you. So roughly 20% of the bank's loan book, that's about $964 million of assets, had been restructured by the end of 2020. But is the bank justified in being somewhat positive about an economic recovery this year?
Good evening, Rama. Yes, I think there is reason to be cautiously optimistic. If you look at the leading economic indicators, it seems like there has been a strong rebound in economic activity since the major lockdown was lifted in 2Q last year. GDP growth is widely expected to rebound to around 5-6% this year, and that I think should lead to a rebound in corporate and SME profits, as well as a recovery in personal incomes, which in turn should be, I think, positive for the performance of our bank's loans. Looking at some of the other economies whose fundamentals are much weaker, we have seen a strong uptick in performance rates, and I think we should see something similar in Kenya. Having said that, I think the one area of uncertainty is the real estate segment, which forms almost 26% of the bank's restructured loans. As you know, there is an ongoing correction in the segment due to oversupply, especially in the commercial and upper income housing segments. So there is a possibility that this segment could take longer to recover, and depending on the magnitude of the recovery, the bank may need to make additional provisions and write-offs for this particular segment.
Let's explore the downside risks in a bit more detail, because looking forward into 2021, 2022, if you look at the Kenyan vaccine rollout plan, that stretches all the way to 2023. The vaccine rollout plan has been relatively slow compared to even peers like Ghana, for example, and it's not 100% clear exactly when the economic drag from this pandemic will essentially be lifted from the economy, especially on household incomes and jobs, as we saw last year. So given that particular outlook, isn't that likely to be a drag on both incomes and, by extension, the interest income and non-funded income that banks will be reporting?
Sure. There's definitely downside risks, given the potential delay in vaccine rollouts. We still don't know what happens if there's a new variant of COVID, all that kind of stuff. But I would say the outlook right now compared to where we were 12 months ago is definitely a lot more positive. We definitely have a much better idea of just how to live with the virus, and therefore, as a result, I think the banks should be in a better position to navigate through that compared to 12 months ago.
Indeed. So interest income did rise in this particular year, but you flagged an interesting risk moving forward for KCB, whether or not their risk pricing model gets a speedy or delayed approval from CBK. Walk us through that.
Yeah. So, the central bank has certainly taken its time to approve banks' risk pricing models, given that the rate cap was repealed, at the back end of 2019. I'm not sure if the delay is due to COVID-related disruptions or if the CBK is just not satisfied with the models that these banks have submitted. Having said that, if you look at the economy, it is in need of a boost. And the fact that, fiscal policies should be tightening, given the recent deal with the IMF, I think, the central bank will have to do the heavy lifting in terms of uplifting the economy and stimulating growth. So, one way of achieving that is, trying to get stronger loan growth. And I think the only way that they're going to be able to do that right now is approve banks' risk pricing models and allow them to underwrite slightly higher risk loans, such as SME loans. So yeah, I think reasonably optimistic that the risk pricing models should be approved. And if it is approved, for KCB and I guess for the rest of the sector as well, especially the tier 2, tier 3 banks, I think it should be a positive, as it should lead to stronger loan growth and slightly higher margins as well. Although I think the uptick in margin should be more gradual, because banks will be conscious of the presidential elections in 2022. I'm sure they'll have their memories they'll remember what happened back in 2016, 2017, and also I think they'll be conscious of the tough operating environment.
Indeed, and I'm glad you brought up the wider social and political environment, because I was going to ask about the converse argument, because the regulator may look at what's happening now, looking especially at the results that are coming out for 2020 from KCB, Equity, Stanbic, the lot, especially the tier ones, and say, well, if you're making money with essentially rates where they were last year, and we've essentially kept a lid on transfer fees as well for bank to mobile money transfers, then we don't actually need to give you guys a break right now. You'll be fine as it is. I mean, isn't that just equally as realistic an alternative?
Fair point. Look, even with the risk pricing models not approved, and even if you look at banks' numbers when the rate cap was in place, the net interest margins for banks was around 7-8%, which, when we look at our universe, it's amongst the highest within the frontier universe. So the banks were making pretty decent profits in that environment. However, there's two things I would maybe clarify within that. Yes, some of the banks were making profits, but by and large, the profitability was concentrated.
All right, then let's get back to our earlier interview with Ronak Gadhia of EFG Hermes. So Ronak, good to have you back. So you're essentially in the middle of explaining why the argument about essentially keeping rates where they are at the moment needs to be approached with a bit more nuance, because a lot of the earnings that we're talking about are concentrated in the top tier of the market, and the mid-tier and the lower end of the market are essentially facing really compressed margins.
Sure. Look, on principle, I agree with you. If you look at the NIMs that the banks were reporting last year, or even during the rate cap period, there was earning NIMs of 7-8%, which are amongst the highest within the frontier universe. So in that case, you could make an argument that why do they need to price higher? However, the two counter arguments to that is, firstly, if you look at the profitability of the sector, the profits were largely concentrated amongst the top tier banks, the top 8 or 10 banks who have, strong deposit franchises and low cost of funding, and therefore were able to offset the lower lending rates. If you go lower down, banks are struggling to make profits to meet their cost of equity, and that's not a healthy situation. So in that case, there is an argument to be made that lending rates need to go higher, especially for tier 2 banks. And then the other point is, yes, the tier 1 banks are making a huge amount of profits, but if you look at the intermediation within the sector, if you look at the deposits to GDP ratio, loans to GDP ratio, it has largely declined since 2016. And the banks have been able to replace that either by growing some of their fee and commission income, or making money off the government through T-bills and bonds and that kind of stuff. So again, I think the idea going forward should be to allow banks to price higher, so that the intermediation within the sector improves. But it is very sensitive. On the one hand, you have to let the rates go higher, but at the same time, you have to make sure they don't go back to the levels they were back in 2016. It's quite a sensitive discussion, and probably that is the reason why, one of the reasons why the central bank is taking its time.
Indeed. One last question for you. In his call earlier today, Joshua Oigara, the CEO, acknowledged that the work of restructuring part of their loan books is far from over. He sees it as a 2-year process. But given the macro uncertainty that the bank operates in, do you think paying that dividend was the right call? Because on one hand, it's easy enough to say, well, we're going to give shareholders close to $30 million, but you're also taking in $100 million in order to lend that out from entities like the IFC. I mean, shouldn't they have just kept the capital?
No, I disagree. If you look at the KCB in particular, at the end of last year, the bank's capital adequacy ratio and the group capital adequacy ratio was at a multi-year high. It was close to around 20%, if not slightly higher at the group level, which is the highest it's been since 2014. At the same time, the discussion we were having earlier, the outlook right now compared to 12 months ago is definitely a lot more positive, as we have more knowledge about the virus, how to contain it, and obviously there's the hope of the vaccine as well. So, given that environment, given that the guidance from management is that asset quality NPL ratios have peaked, I think it would, given that context, I think it would have sent out a very negative message if the largest bank in Kenya, one of the most stable banks in Kenya, did not pay a dividend. So I think from a signaling effect, I think it was important for the bank to pay a dividend. It just gives a more reassuring message to its stakeholders and to the wider economy. And in that regard, given where the bank's capital adequacy ratio was at the end of last year, I was actually surprised they paid a dividend of only 1 shilling compared to 2 shillings 50 cents the year before. I was actually expecting a higher number.
And so they essentially split the difference. Ronak Gadhia from EFG Hermes, thank you very much for your time this evening.